Good morning, everybody. Welcome to the first 2021 NADA DPP Performance Program. My name is Marq Dommisse. I'm your NADA Chairman, and today we are joined by two really lovely panelists. Mark Roberts, CEO of the Fury Motor Group, and Krista Kock, CEO of WesBank. Welcome, gentlemen.
Good morning.
Good morning. Nice to have you here.
Good to be here.
Good. Before we get stuck into the webinar, I just would like to talk about some of the topical issues that the NADA executive is currently dealing with at the moment. There are quite a lot of them, and just to let the members know that these are obviously on front of mind and on the agenda of what we're dealing with at present. Right to repair and the guidelines that were issued in December, we'll discuss these. We've got some really good feedback from NAMSA, and the NADA NAMSA collaboration has been really, really fruitful, and we've got some good feedback with you on the guidelines and the way forward from there on. And we'll have a nice discussion with Mark Roberts and also Chris on a couple of those topical issues. NADA is also going to be doing their DSI survey later in the year. That is going ahead. As you know, last year, because of the COVID lockdown and the disrupted trading, it wasn't really viable to do a DSI survey. This year, however, we are going ahead, which is very exciting. NADA will also obviously continue to do these DPP programs, and we've got 2 more sessions later in the year to do, which is going to continue to deal with these topics that we're dealing with at the moment. We'll also be issuing a transformation policy this year, NADA, an official one for NADA members, which is really, really good. And what is also very topical right now is DIC. As you know, the Financial Service Conduct Authority has DIC on the agenda, and the main reason for this is to make sure that DIC is fair for the consumer. Very encouragingly, the FSCA has approached NADA as well as the big credit providers and BASA, and we have been working as a collaboration, giving them a lot of information. The tone from the Financial Services Conduct Authority has been very positive, and we feel that they are trying to get the best result for the industry and not be a disruptive force. So we are really working with a really good team with the banks and really trying to get a positive result for the industry. So just to let you know, these things are being dealt with and all under control, hopefully. The January market, I think we all had quite encouraging results as dealers leading up to the end of last year. While volumes were a little bit down, I think we could all feel that there was a bit of margin back in the business, as well as quite a strong used car market. However, January was quite soft, and I think we were all a little bit concerned going ahead as to the January market. Mark, how did you feel January went?
Yeah, Mark, I think you're right. I think the second half of last year was actually quite encouraging given what was forecast and what the potential situation was for it to end up way worse than that. I think looking at January, from a dealer perspective, a significant drop on January the previous year, obviously, 40,000 units January previous year down to 28,000, I think, so major drop. We expected it to be down, but I didn't expect it to be down as much on December 2020, down from 33 to 28. So yes, concerning, perhaps attributable to the late December reintroduction of the level 3 adjusted regulations, put a lot of consumer sentiment maybe into very wait and see mode, nervousness from consumer side. But there is another factor. I think right through the fourth quarter, we saw declining levels of availability from a number of the major brands. And that started to reach really much, when I say not dramatic, but certainly the impact of availability in January, was significant. So what percentage is attributable to availability, what to consumer sentiment, the percentage down, quite difficult to judge at this point in time. But I think both those factors had a contributing factor, and where to from here, difficult to anticipate because the availability issue, as we understand it.
I agree. I mean, I think also we were hit by also another challenge in our business. Besides this looming new car supply issue, we've also got a bit of a used car supply issue. And
Yes.
used cars right now are really difficult to find. I also think with, at the time, coming up even into January, the rise in infections was still going the wrong direction. And I think it really makes consumers nervous. It's no different to the rand going to 20 to the dollar, etc. It was really alarming. And also the closing of the alcohol market and restaurants. I think that all took its toll, and I felt January was a real challenge. While we're onto the supply issue of vehicles in terms of new and used, I think it's time to do our first poll. So as we know, our used car numbers on our floors are dwindling a bit, and stock is at quite a short supply. I think it's time for us to do our first poll. So you should see on your screen, how are your used car stock levels at present? And we've got 3 options. I'm stocking to normal levels at the moment on my floor. I'm stocking to 15 to 20% less, or I'm stocking 30 to 40% less. So we'd like to just put that out there. Okay, so the majority of the dealer network is saying that they are at least 15 to 20% less stock, and the second most prevalent one is 30 to 40%. So I think, wow, that's quite something. And there's a few dealers that are lucky, and they seem to be bursting with stock. So, but generally a lack of used car stock supply. So while we're getting a nice bit of margin feedback there, I think that's an ongoing challenge. And I don't know, Marq, if you think this is going to sort itself out on used cars.
Look, I think that there's a number of challenges there. There's the new entrance into the market in terms of people like WesBank, not new, but becoming significantly more dominant players. That is impacting on some of our ability to trade vehicles in. And then whilst the new vehicle demand is low, the trade-in numbers are lower. So I think it's until we see a change in that trend, I think we're going to the used vehicle stock shortage is going to persist for quite a while.
I think, Mark, we can't discount the fact that the rental companies are not offloading stock.
Absolutely, yeah, that's it.
And I think that just interestingly, from the WesBank numbers, we see that the customers are hanging on to their cars much longer. You know, we used to hover, in the good old days, we used to hover around 3 years. That was our average time on book. That number is now 4 years. It has moved out 12 months.
Wow.
So that's significant. So if customers are turning slower, then you're going to see that on the used car lots.
Absolutely.
Sure. So to add to that, I'm sure a number of you might have had a few sort of supply warnings from your manufacturers, and it seems to be a major squeeze on certain key lines within new cars. The one major reason is I don't think anyone anticipated the level of recovery post-lockdown in the world, and it's very difficult for the manufacturers to ramp up production when they call a number, when you have a worldwide supply. And the other thing is these semiconductors that are in short supply. It's quite a fascinating topic. The first problem is that one of the biggest semiconductor manufacturers in Japan, their factory burnt down or had a major fire, constraining supply. And the other area actually is the changing of consumer habits. I know now I have 2 laptops in my home that I didn't have 12 months ago, because I have 2 kids at school and they both need a laptop. And that alone, lockdown, the gaming industry, and the new cell phone coming out on the market has put a huge amount of strain on semiconductors. And also the Trump sanctions in China. He didn't want really any of the big semiconductor manufacturers to have the latest technology, and that has put a massive strain on the chip markets, and that is one of the reasons we are not going to be able to get all of our vehicles that we actually think we can get over the next 3 to 4 months in some lines. So we'd like to introduce another poll. If you can bring up the poll, please, guys. And this is really on new car stock supply. Don't know, it's going to take a bit of time to do. There we go. Is it coming? Okay, anyway, we'll move on to that poll just now. Basically, okay, there we are. Fantastic. So it'll be interesting to know from the attendance is how concerned are you that your OEM brand new car supply will be seriously constrained over the next 3 to 4 months? And I think that's the sort of period that we're looking at. The first one is not concerned at all, mildly concerned about models and key models in short supply, and very concerned about key models in short supply. So having a look at that, Once again, it seems to be number 2 and number 3 that are the most popular ones. Quite a large number of attendees are very concerned. About 67% of the population is saying that they are very concerned on new car stock supply. So that seems to be a trend that we're all going to have to deal with this year. Quite concerning, I must say. Linked to the market, we're very fortunate to have Kock to do his market, the WesBank market forecast, as well as a lot of the economic indicators that are really hitting us. I love economics and I love all the macroeconomic stuff that is always a force in our market. So Chris, welcome and thank you very much, and really looking forward to the presentation.
Thank you very much, Mark. So let's perhaps start by looking at this time last year when WesBank made the economic prediction, because I think this is relevant to think about this, because obviously this time last year we had no idea about COVID. So we were looking at the economic fundamentals of the country, and our prediction for 2020 was predicated on just how well is SA Inc. doing, just how well are consumers and businesses doing. And you can see that we were forecasting a low growth environment. We were concerned about the impacts of power outages, massively low business confidence already before COVID, low business confidence, and consumers were expressing very low levels of confidence. Of course, very high indebtedness from customers. We had lots of political issues happening at the time, if you can recall, employment growth under pressure, and then this narrative from the rating agencies about what is happening in South Africa. So if you look at the numbers, if you look at the actual performance in 2019, it was at 536. We predicted that the market would actually deteriorate by 3.5%, mainly as a result of some of these economic realities. And of course, we all know that the market came in at a massive 29.1%. Now, of course, that was massively impacted by COVID. So what we try to do before trying to predict what's going to happen this year, we try to go back and say, let's normalize. So if COVID hadn't reached South Africa and it wasn't a factor in the world, what kind of performance based on the first 2 months that we had? So we had January and February, which was not impacted by COVID, obviously, and then we looked at the economic factors that we referred to in the first slide, and how had those progressed during the course of 2020, and sort of we imputed how that would have sort of related ex-COVID into a normalized year. So we predicted a 3.5% fall, as I mentioned, and when we imputed January and February, and when we looked at updated economic performances, we actually thought that a normalized market would probably have come in at around 5.7%. So we were slightly off, we thought, in a world without COVID, but still a reasonably acceptable number for an industry like South Africa. Turning our attention now to this year, if you think about the shocks that hit the economy as a result of the first wave of COVID. And I guess it's always nice to try to understand these when you think about our current account, our capital account, and domestic supply and demand, because that's where, that's how we can best sort of interpret these things. So if you look at our current account, obviously the whole, you spoke about closing manufacturers. There was a collapse in exports, not only in the motor industry, but all industries in South Africa that were exporting anything other than basically food properly collapsed. And if you're not selling stuff, then you're not getting revenue in, and that put massive impact on our current account, which is really the flow of money between South Africa Incorporated and the rest of the world. Commodity prices fell dramatically, and of course tourism completely evaporated. So current account was under massive stress. This was no different actually in other periods of our economic history in South Africa, specifically in the financial crisis in 2008. We experienced exactly the same things. On the capital account, again, because of the panic caused by COVID, there was a significant fall in global capital flows, particularly to emerging markets such as ourselves. So we saw a fall in equity prices, actually a plunge in equity prices, better described it. The rand went pear-shaped, and of course this all contributed towards an increased funding cost for South Africa, which from a rating perspective deteriorated. So people who were loaning money to us through our bond markets made that money more expensive. So a big shock in our capital account again. We had already experienced this in South Africa in previous down cycles, so we knew that this was going to be the impact. I guess what we hadn't experienced before was this domestic supply and demand shock. So again, a complete collapse in the manufacture of goods and services. So even though customers wanted to buy stuff, there just wasn't stuff to buy because nobody was able to manufacture, and nobody was able to import as a result of the lockdowns. And then from a demand perspective, unemployment and the threat of unemployment was a massive concern for people. And of course, when you've got those concerns hanging over your head, the last thing you're going to do is go out there and buy stuff. So that was a huge issue. Massive uncertainty is, how long is COVID going to be with us? What is the impact going to be on our world? And then this earnings threat. I think a lot of consumers experienced some, if not all, loss in earnings. Particularly those people who rely heavily on variable earnings such as bonuses, share allocations, commissions, those things all but disappeared. So we saw a massive fall in earnings, which of course impacted demand for goods and services. If we look now as we near the end, hopefully, of the second wave, really nice to see that the numbers are starting to come down nicely. They're now around 1,000 from the 23,000 we saw at the peak. So you'll see that the lockdown restrictions were substantially more moderate than what we saw in the first wave. So you'll see that the impact on the current accounts, other than tourism, is a lot more moderated. So we don't have that pressure on the current account. If you look at the capital account, none of those factors that impacted the capital account are relevant. In fact, the rand has strengthened, the equity markets have rebounded quite strongly, and the rating of South Africa from a funding perspective has improved. So the bond yields have fallen, and actually funding has become cheaper for us, which it wasn't in the first wave. Unfortunately, the domestic demand and supply shocks haven't completely abated. I would say that from having massive headwinds in terms of supply, those are, from having collapsed supply, those have turned into maybe headwinds. And a good example of a headwind in supply is exactly the point that Marq was talking about earlier, in that the supply constraints in our business, which is cars. And of course, level of lockdowns, whilst less restrictive, still are putting a bit of a dampener in, and particularly on travel and tourism and the entertainment industry. If you look at domestic demand, again, it hasn't collapsed, it's actually recovered. And I'm going to show you a slide now of F&B data, which I think you'll find quite interesting. But of course, there are still lots of factors that are worrying consumers and holding them back from committing to a vehicle. Unemployment, a lot of the government subsidies for both small businesses and for private individuals are falling away now, as all of those programs roll out. Every day, if you open the newspaper, you will see another company announcing large tranches of retrenchment. So there's no question that people are still nervous about unemployment. Uncertainty remains. Political uncertainty hasn't changed at all. We still are unsure about whether the reform agenda is going to be prevalent. We didn't get any substantial confirmation of that in SONA, and I expect that next week's budget presentation is equally going to be quite difficult for us to get any degree of certainty. And then, of course, earnings. We still, people who earn variable are still much lower. Are we going to have a bonus this year? Is the equity market going to rise this year? I think there's still a lot of uncertainty that is going to impact. And the January performance that Marq spoke about, these factors are playing, I can assure you. This graph is interesting because it's from our F&B transactional data. And the red line is this year, and the blue line was the prior year. So it gives a direct comparison of the activity levels in the marketplace. And of course, you can see in the March-April period how people just spent no money whatsoever. and you can see how that has recovered. Mark said, referred to how the recovery has actually surprised and shocked a lot of people, but you can see it clearly here that people went back to almost normal spending habits on particularly semi-durable and non-durable goods such as food, entertainment, those types of things. You can see in level 3 lockdown there was definitely an impact. Mark referred to whether level 3 lockdown might have impacted sales towards the end of last year, early this year. You can see it there that customers are again in level 3 lockdown experiencing different spending patterns. But I guess this is a positive slide in that it shows the capacity for spending, that it is there, and as soon as some of these factors are dealt with, like the threat of unemployment and more certainty in the market, I think we'll see a rebound in car sales. So let's get to our prediction. So this number, just to remind you, was the normalized number for last year. It was 5.5% lower, 5.7% lower than 2019. Our prediction for 2021 is 426,000. Which is a 15.8% reduction in what we thought would be a normalized 2020 number. And I show it this way first because when you compare what we think we're going to sell this year to what we sold last year, I don't think that's the right comparison because it looks like the picture is quite rosy, but in actual fact the picture is anything but rosy. So 15.8% back from what we would have sold if it wasn't a COVID year last year is still a quite a dramatic shift back in the market. If you look at last year's number, it represents the 426 represents a 12% growth in what we sold last year, but I think 426,000. The question that I'm sure we're going to ask is what is the right number for a market such as South Africa? I remain convinced that the lofty numbers of 600 and above are not the right number for South Africa. I think that number was falsified in many ways by moving new vehicles into certain sectors of the market that actually the market could never had the capacity to absorb. So what is the right number? And I'm sure we'll have a good discussion about that in a second. Mark, thank you very much. So again, sorry, just the final slide. That 426 takes us back to a decade ago. So we're going to have to deal with a market that is similar to what we sold in 2009, which obviously brings with it a whole bunch of challenges around efficiencies and cost management in all of our businesses. Thanks, Mark.
Brilliant. Thank you, Chris. That was really, really useful and quite eye-opening as to how we've gone back to that post-financial crisis period, where back in 2009 to 2010. I think the question is at 426,000. I'm quite comfortable with that number. I think it's a very solid forecast. And I think we'd all be quite comfortable with that or a little bit more if we get out to this year and just have some predictability and a bit of a solid market. But the question is, what are the stumbling blocks that might enable us to struggle to get there? For instance, we've got the budget speech coming up. We don't really know what's going to happen there and what the predictions are there. But we are in still semi-lockdown. We are having lots of challenges. So I don't know what your thoughts are on the risks to that number.
Yeah, so I'll let Mark talk maybe to the supply constraints. You mentioned that earlier. I think that is a real constraint, and in fact we baked that into our number. I guess in the absence of supply constraints, our number would have been substantially higher. But so if I just turn our attention economically, I think the budget speech is going to be interesting because Tito has to balance something that is actually impossible to balance. So are we going to have, for example, tax hikes, both corporate and individual tax hikes? I'm sure all of us read with horror later in the week and earlier this week about a 15% increase in electricity. Now, that is a tremendous punch in the gut to businesses and to us as private individuals. Now, all of these things take money out of the pockets of our consumers, and that so I think that is the risk factor. I think politically, if we don't fast get onto a transformational agenda, if the budget doesn't work towards saving money and actually not paying off debt but borrowing less. At this stage we will simply take a a borrowing less outcome as opposed to a saving outcome. Because if that doesn't happen, then we are going to get downgraded again. If we get downgraded again, then the cost of government servicing their debt increases, and therefore they have less money to spend on investing in the economy, and then our economy just remains locked in this first gear. And I think those are some of the headline risks. We're not going to get any help from interest rates. The interest rate cycle is at the bottom. We've never ever had interest rates so low. There was talk about another 25 basis points, but it doesn't help when rates are at 7%. 25 basis points doesn't make a big difference, and I think the MPC, which meets this week, is they're certainly not going to give it to us now, and the challenge is they might not even give it to us. In fact, if that transformation agenda doesn't kick in, then actually we could see increasing interest rates, which would also be negative. And then I think just the final one is on credit. The availability of credit. So far, the market has been supported with the availability of credit, but credit, individual credit ratings have fallen. If we look at the applications that we receive this year, and we compared it to the applications that we received last year, the average credit rating is substantially lower this year. So customers are actually in a much worse position. And so even if our credit appetite doesn't change, banks are going to be approving less. And I think that also is a factor we need to think about.
We were debating the dealer market, so within your number, 426,000, in the prior year 380, the dealer market fell from, I think, 434 in 2019 to about 324.
325,
So the dealer market was 325, and I think the big question on our minds is what will the dealer market come into you were this year within the 426 mark?
Yeah, Chris, I was interested in you saying that without the supply constraints, you think that the 426 would have been significantly higher. I think that would be interesting to try and get a handle on that number. So that's saying there is still consumer demand out there, which is going to be constrained a bit by, it's going to be constrained by sentiment, but it's also going to be constrained by supply. But if you look at the dealer market in the COVID year in 2020 was 85, almost 86% of the total market. That's probably the highest percentage it's been, I think, in a long, long time. It normally hovers around 80, 81%, somewhere around there. So in that 426, what would you say? Are we headed for an 87% dealer, or do you think we could rely on an 85?
It's a good question, but let's just talk about demand. What fascinates me always about this market is that our application volumes have reached records. We break records month after month of people that, I would imagine that you don't apply for finance unless you're thinking of buying a car. So one can use that as a fairly decent proxy for demand. But unfortunately, the conversion of those applications by all the banks into actual viable approved deals is just plummeted. It's fascinating. It always is amazing how actually customers ask banks to tell them whether they should buy, whether they can afford a car, as opposed to making that call themselves. I think on the dealer side, the rental companies were a big offtake of vehicles, and I think we all know that the motivation behind that was partly because they wanted to serve the rental car market, but part of it also was because in this world of excess demand and not, excess supply and not enough demand, the manufacturers made it easy for rental companies to buy cheap, run for a while, and then make great revenue out of the used cars. But it's unlikely now that manufacturers are going to push low margin volumes into the rental market, even if the rental market ask for it, which I can't see how tourism is going to bounce back this year at all. But they probably will ask for it because they need to pay their bills through that sort of buy low, make money on the used cars. But I think the manufacturers are unlikely to move a considerable amount of vehicles into that channel, because I'm sure it represents a much lower margin for them than moving it through the dealer channel. So I think that you could probably expect for a similar type of percentage of vehicles sold by dealers, which I suppose is a bit of a silver lining.
Yeah, I think it's always interesting dissecting the market a little, and a lot of the the journalists and the commentators every month don't often look behind the numbers.
No.
I mean, they don't look. They talk about the overall number, but I mean,
The dealer number to me is more important.
you know,
That's a consumer number. Yeah.
And I mean, last year, 2020 against 2019, government sales grew. And is that likely to happen? It depends on how much they're going to spend on infrastructure development, I guess. So, and there's been a lot of talk, but nothing happening. But and then
there are a number of tenders out, Mark, that were out last year. So, like the city of Johannesburg, 3,800 units.
Yes.
That tender was supposed to be issued and fulfilled last year, but government delayed it because of COVID. So that tender is out again, and there are a number of other tenders that are out. If those tenders sort of break ground this year, then I think government will actually grow in terms of numbers. Whether the industry can supply for those kind of numbers, I mean, that's going to be an interesting debate.
Yeah, I think the manufacturers are going to really struggle to supply any excess demand out of rental companies or government. I think the most concerning thing about January was it was the lowest dealer month that we've had since before the 1st of June. Even the 1st of June last year, our first month out of lockdown, we sold more cars. The supply constraints are a problem, and also I think a bit of consumer demand. However, I think you're probably going to see a pro rata increase in dealer sales, probably to the tune of what we couldn't sell in the months of March and April. Well, in April and May, should I say. But it's going to be an interesting look, and I think Chris is probably right. Within that same percentage increase to the overall market will probably be applied to dealer sales. We have to take a 2-minute sponsored break. Thank you very much, gentlemen. We'll see you guys in 2 minutes, and we'll just start discussing the guidelines and right to repair. Thank you.
Okay.
are we off the?
When you said
Hi everyone, welcome back. On the 10th of December, the Competition Commission issued the guidelines to the automotive market, commonly known as what everyone calls right to repair. Obviously, this has been quite a big disruptive force in our business, and the guidelines have now formally been issued. We have had quite a long process with the Competition Board in the fact that up to about November, early November, NADA had a formal workshop with the Competition Board going through the then guidelines that they were going to issue as final. I can assure you the guidelines that were previously issued before the final ones were certainly a lot more harsh and a lot more dictatorial. And we find that between ourselves, some of the other stakeholders in the OEMs, and certainly even NAMSA, the Competition Board has certainly softened its position in terms of rather collaborating with the industry rather than the harsh nature of the guidelines before, which we were all quite concerned on. The guidelines in general, we feel, are certainly they are a lot more workable. And the other day on Monday or Tuesday afternoon, NADA and NAAMSA had a very nice Zoom meeting just to get NAAMSA's views on the guidelines. It was a very productive meeting, and just to give you some feedback on NAAMSA's position, which are really important. The first item was that NAAMSA's official position is that they are not opposed to the guidelines, and they are workable within the sort of automotive strategy largely in South Africa going up to 2035. The first item on the agenda there, however, is to understand the legally enforceable, the legal position of guidelines. I think there's a lot of confusion to that. I think as industry, we certainly are not in the position of wanting to reject the guidelines outright if they're not legally enforceable. That's certainly not something that we want to do. We want to work with the legal authorities and the competition authorities to try and get this off the ground in the least disruptive way possible. But a legal opinion is necessary, because we don't want to ever find ourselves come the 1st of July to be not compliant with something and for the competition authorities to come down quite hard on us. That could be quite a risk to our business. And we need to understand that this can never ever happen on the 1st of July. There's no ways the entire guideline can be rolled out. It is virtually impossible. NAAMSA's position is that they're actually going to set up a formal NAAMSA implementation framework. And they'll be doing this in collaboration with the competition authorities. And however, it will be staggered. So they're going to go to the competition authorities and say, okay, we can take on the top 5 easy items on the 1st of July. The next top 5 might be phased, and there might be even 1 or 2 non-starters that at this stage we still can't really work with, and they're not practical, and we need to discuss these. And I think that's quite a good practical approach. The idea is for NAAMSA to work as a common voice. We did ask the question, will every single manufacturer sign up to the implementation framework? That is obviously, there's 49 different competing OEMs at NAAMSA level, which is quite staggering. There are going to be slight differences of opinion, but we felt that NAAMSA was definitely really ahead of the game in continuing collaboration and talking to the competition authorities so that we can actually deal with the guidelines and roll them out. NAAMSA are also going to be doing a PR campaign to promote franchise dealers and original parts. And NADA will probably be doing a very similar campaign as industry through the Motor Retailers Forum to come up with a campaign to promote our industry. But more about that later. NAAMSA also will be issuing a press release later in the week. They said it is either today or tomorrow. So I think we need to look at that and we'll continue to have a similar voice to NAAMSA. Marq and I were discussing the guidelines, and I think the challenge with the guidelines is that there are a lot of gaps and unknowns. It's not it's more how the position should be at the end, but how we get there is going to be very difficult, and I think there are a few gaps. Some of the talking points that are really, really quite challenging are something like the non-genuine parts issue. Marq, what did you think? What gap did you notice there when it comes to non-genuine parts and the independent players and the consumer?
Yeah, I think, Mark, a couple of things. I think you're quite right. I think the guidelines are more pragmatic than what we thought they would be, and certainly a lot more pragmatic than what we thought when the initial discussions around this started 2-3 years ago. So it's going to be how the implementation and the interpretation is. I think there's the other thing that's potentially an issue is that there's been some, and not unexpected, the consumer journalists have latched onto this, and there's some irresponsible reporting out there, in my view, already. Inaccurate reporting and irresponsible, but it's that we probably should have expected that. So, and I think what we got to be careful of is a legal opinion versus a guideline. You know, it's how that's handled from a PR point of view, because that actually could stir up more animosity or antagonistic journalism. So we've got to be careful of that. But yeah, so you know, the guidelines are quite interesting. I mean, they define 2 types of parts, a similar part and an equivalent part. And then they say, for simplicity, we're just going to call both non-original parts. So what does the difference mean? You know, is one identical quality and one's lesser quality? I'm not sure. But for the rest of the guideline, they only talk about non-original parts. So, yeah, I think one of the things that I see is very unclear in the guidelines is that ISPs, or independent service providers, are entitled to fit non-original parts to a vehicle that they work on or do repairs on in the in-warranty period. Quite onerous on that ISP. They've got to disclose that. They've also got to disclose the risks of that, which is very pragmatic, I think, in the way they've got to disclose that the manufacturer could find that that leads to consequential damage of another part and invalidate the warranty as a result of that, but that would have to be researched at the manufacturer's cost. So quite complicated, really. But one of the things I think for franchise dealers that is a question is, it says that the consumer is entitled to ask a non-franchise dealer to fit non-original parts. The guideline says that the franchise dealer can refuse to fit non-original parts and only fit original parts. I'm not sure what our franchise agreements don't allow us to fit non-original parts. So the moment, if that is not changed, that's going to be contrary to the spirit of the guidelines, because the whole thing is to bring costs down to the consumer, etc. And the perception is that non-original parts are way cheaper than original parts.
Yeah, I think that's a really good point. Yeah.
So, but the guideline is silent on that. So I think that's a point of clarification that needs to.
I mean, right now, as dealers, we're not allowed to fit non-original parts. But this fact is going to be coming in, and not that I'm advocating this at all. I'm very pro-original parts. However, as a manufacturer, who would you prefer to fit the non-original part? A dealer that's got all the technical expertise, you can control that part, as opposed to the ISP or a non-even approved. So I think it is a good control mechanism, and I think our dealer agreements are definitely going to have to be looked at in light of the guidelines and how the cards fall.
Yes.
Chris, you were mentioning about customers, for instance, not taking service plans and maintenance plans, and the risk of buying up to a more expensive car, but having this maintenance risk, and what the bank's view is on that.
So I think we take, obviously the vehicle we use as security for our loan, and it's important to understand the fact that we have security means that from a Basel IV perspective, we have to hold less capital, which means we can charge less for the loan. I mean, that's really how it works. So the equity in the asset and holding the asset as security is a very important part of the whole equation. So we take a lot of comfort now that these vehicles are well maintained, and the value of our security is actually maintained through the life of the agreement because of these warranties and these maintenance plans. We fear that the minute the manufacturers and the franchise dealers are then forced to disclose that separately, that given the choice, consumers will opt more to spend that money on maybe another accessory or a more expensive variant of that particular car, because unfortunately consumers are very short-minded, and if that is the case, then obviously our security will deteriorate, and our models will have to reflect that, which ultimately will lead to to lower approvals, which is not a great outcome.
Yeah, and also the risk of a consumer potentially losing his warranty halfway through the life of the book or of the loan, and you maybe not knowing that. And then all of a sudden you suddenly have this big exposed risk on a very expensive car with high debt, and suddenly something happens and there's a 100,000 rand engine bill, and the manufacturer won't pay. That is a problem, big problem.
Yeah. And I mean what we know is that customers live, and I don't think it's unique to South Africa, but certainly in South Africa, customers live on the borderline of income. They don't have a lot of savings. So if they get faced with and I mean these modern cars, if something like material breaks, some of the electronics or the gearbox or something material, we're talking about a bill of 20, 30, 40, 50, 60,000 and upwards. That is enough to literally bankrupt customers.
Yeah, that is a real challenge. Interesting as well, Mark, is to see what line each manufacturer takes, because I don't think anyone's going to be exactly the same. I've heard rumblings of certain manufacturers saying, well, they're not going to unbundle the service plans because the service plans are free. Other manufacturers are saying, well, we have to disclose everything. So it's quite interesting the take some of these manufacturers are going to have to take on the 1st of July.
Yeah, I think that's going to be one of the biggest debates in terms of the timing of the implementation, and try and get some clarity. And these are guidelines, but the guidelines are very specific in terms of those costs need to be unbundled and full disclosure to the customer. It also goes as far as to say like the insurance industry, although service and maintenance plans are non-insurance products, it's saying that any sale by the dealer or any other third party to the customer, all the commissions have to be disclosed to the customer, like it is today when you're buying long-term insurance or whatever. You know, the brokers have to disclose it to you. That hasn't been a requirement up to now. The guidelines saying that those commissions have to be disclosed. So some work to be done on our systems, in the dealerships, and the documentation that customers get from us, etc. So quite a lot of work to be done there. But probably the most significant, I think, when I say threat or potential impact on us, is the potential for less throughput in the workshop as a result of customers not taking up the service or maintenance plan, as Chris said, because they're on the borderline. And then the perception that they can then get their vehicles serviced from time to time or within the warranty parameter at a non-franchise dealer. And they believe, because they don't have the service plan or the maintenance plan, it's going to be done at a cheaper price. So those are the real threats. I think that's probably quite a big percentage of our customer base is, as Chris says, would rather go up a model than pay for the service or maintenance plan. And it's going to have to be an onus on us through the sales process, the F&R process, to really try and educate customers about that. And how we're going to have to do that in-house.
I think it's a really good point. I think 2 points from what you were saying, Mark. One is, I think therefore the NAMSA implementation framework that'll hopefully be communicated and agreed with back to the competition board will alleviate this hard deadline. It's sort of like a hard Brexit, that we need to, it's not going to be all in place on day one. And I think if NAMSA can get it right, and hopefully NADA can also have some collaboration with ComCom, we can at least not have this really hard deadline and have the right to repair brigade, which probably will come out on force, plus the competition authorities on our backs. We don't really want as dealers to be under scrutiny from the competition board on the guidelines. They're not really our guidelines, they're actually for the manufacturer. So that's a problem. The other thing is in terms of your point on selling service and maintenance plans and the risk that customers won't come into our workshop. I do agree that consumers are on the breadline. Lots of people eating hand to mouth. But there is a South African culture that, the customers do like service plans in this country. They do like maintenance plans. So it is going to be interesting to see. However, this has happened all over the world, and I think it's up to us as dealers to do a better job. And I think there's going to have to be a lot of PR and a lot of campaigning in the industry why franchises are a good place to service your car and maintain your car, and the fact that we actually are not that expensive. I don't think the alternatives are going to save consumers a hell of a lot of money. Maybe on the parts, but however, how long term will that be? You're always going to have a better deal once you have your manufacturer part. And I think the risk of putting non-genuine parts into cars early on in the life cycle, I think, is a recipe for disaster.
I'll just add that don't bank on consumers to think long term to justify, because that's a mistake. I've heard some dealers say, but then cars will be cheaper, so we'll sell more cars. Again, a very short-sighted view. A very short-sighted view, because if that customer falls over and has to lose his or her car, then they're out of the market for the next 10 years. So I think short-sighted approach is going to be the big evil here.
I think the other point, is that, the guidelines refer to their referral to all these other markets and, where it's been implemented already. And probably, I think we could look at it and say, well, we could take some comfort in that in the UK, Western Europe, Australia, a market not so far different from ours, when these regulations were put in place, also from anti-competitive, driven by anti-competitive regulation, the impact to the franchise industry was very small. A lot of noise at the beginning, and then it waned, which we will have a lot of noise at the beginning, and it will wane, probably the same. But as another group exec pointed out to me the other day, he said that it's quite different, though, in comparing the South African, our model compared to maybe some of those other models where we operate on very low new vehicle margins, and a higher margin in the area of service and parts. Whereas in other markets, the margin is potentially a lot higher on the new vehicle and very much lower. So the change for the consumer in the area of service and parts wasn't that great. So he might as well go back to the franchise dealer. So we've got to be very cognizant of that as well, just by comparing ourselves to those other markets. I mean, it's not quite.
I think generally our parts do get marked up across 2 or 3 factories by the time they arrive in South Africa. So our parts supply generally is a little bit expensive.
Yes.
I'd agree with that. I think that is a risk, but I do believe the manufacturers it's an opportunity for them to sharpen their pencils on parts or cost of parts. Here's a really nice question from the audience. Should the franchise agreements be amended to accommodate the fitment of non-original parts? Could this not only serve as a retention of in-warranty repair, but also an opportunity to win back lost out-of-warranty repair? My view on this, I think it's a huge opportunity to get out-of-warranty customers onto your floors, into your best experience dealerships. Surely you'd want that. Obviously, the ISP process has to be a process going forward, and these people, they do need to start appointing ISPs, but that process is going to take a long time. I don't think it's going to be very easy at all. And we'll talk about some of the complexities with how these manufacturers are going to have to award ISPs. But do you agree with that question?
Yeah, I think that, quite clearly, the fitment of non-original parts as defined in the agreements for a warranty repair while in warranty won't be allowed, and I think justifiably not allowed. There's got to be a certain, particularly if the manufacturer is paying that bill, which they will be. But for longer term retention of out of warranty customers, I think it is an opportunity, because it's quite clear that so many of these parts that are supposedly, they're non-original, they are equivalent, as the guidelines uses the word equivalent. So they could come through the manufacturer part system to us, and out of the same factories. And by utilizing that, could be an opportunity both for the parts business of the OEM and for the parts business of the franchise dealer. So, I think a real opportunity, actually.
Good. Here's another question from Eric Scoble. Can you just make it a bit bigger? Will banks price cars without warranty plans higher than cars with full 5-year plans? I assume maintenance plan. You sort of did allude to that earlier, Chris. I don't know if you can help with that one.
I'm not sure that I understand the question. I think obviously the price of the car will be lower without the maintenance plan. So we'll have to rejig the way that we look at equity, because today we compare equity to with the maintenance plan. So you can't compare the 2 different scenarios with the same equity price. So we'll have to adapt that.
I mean, naturally there must be a bigger risk without the maintenance plan, without a doubt.
Without a doubt.
But I don't think it's really warranty. It's more about the maintenance plan. Okay, good. Another area of the guidelines that could potentially be a really big benefit for dealers is the areas on CI, corporate identity, and the fact that the guidelines are trying to make corporate identity costs cheaper and lower barriers to entry. But there are, however, quite a lot of barriers to entry. So the one area we're talking about, and it's a bit of a debate, is should your Springs dealer be at the same level as, in all respect to people that live in Springs, be the same level of CI as a dealer, for instance, a brand center type thing in Sandton? And how do you overcome that, especially now with ISPs coming on board? Should it be the same for everyone, or should there be a different tier? We have different tiers, for instance, in metro dealers or in city versus the country type dealers. And Marq, I don't know what you think about that.
Yeah, those guidelines are very specific that the OEMs have got to lower barriers to entry. And I mean, obviously, they even refer to estimated costs of establishment of a new dealership, etc. So, and the requirement for imported furniture and imported tiles and all those sorts of things. I mean, I think a lot of that is already being negotiated through dealer councils, etc. And some of those really onerous and impractical requirements are being reduced. And most of the OEMs already have a differentiation, as you say, in terms of requirements. The issue is, when is a metro dealer, and because there's a very defined difference between a rural dealer and a metro dealer, and it's normally around throughput, okay? And it's just not practical for people with a low throughput to have that level of investment. But in the greater metros, in the bigger metros, there are outlying area dealers that this is where I think there's a little bit of a push to say open points in those areas. We should be considering those for the people who we need to bring into the industry, etc. And those guidelines should be lowered. But there's no difference in the throughput of dealers on the outskirts of a metro, dealers in the center of metro. So there's no real difference in the throughput. So I don't think it would be equitable to have differing guidelines, but the guideline or regulations by the OEMs or rules, but the guidelines are implying that. And I'm not sure how that's going to be handled going forward. I think the other real issue, when we talk dealer investment, we always refer to buildings and bricks and CI and furniture and tiles and all that. But the one thing the guidelines are silent on are systems and systems integration. I mean, that's becoming a bigger, in my mind, barrier to entry for ISPs. That's a major barrier to entry, and there's been certainly no relaxation by the OEMs on that. That's just ramping up as we sit here. I mean, there's just more and more requirement for system integration and dealers to have more sophisticated, costly systems. And certainly the bigger systems providers are spending that money on that integration, but there comes a point where that has to be passed on to the dealer. And I think that's certainly a barrier. I mean, how do ISPs integrate to multiple OEM systems? It's just impractical. I just don't know how that's going to happen.
Yeah, and I think the IT cost within the requirements of an of an independent service provider are going to be significant. They have to have a system like a carriage or ADP or anything like that. And number two, they're going to have to integrate with the manufacturer systems. And I think that's just a massive cost. I mean, these are global systems that are quite challenging. So that is, and I think that's one of the reasons that this isn't going to all happen magically on the 1st of July. And I think a really good thing that NAAMSA have done now to go back to the competition authorities and request a phasing in. And I think the longer that the time period this takes, the more opportunity we've got of just letting the cards fall and seeing how this is all going to affect us. We've got another question from Bruce Pitt. At the moment, there are certain dealers who make no margin on new vehicles and rely heavily on direct incentives from their OEMs. Is this the way forward? Very similar to the agency model. So I think he's saying don't know what you think about the agency model versus the current model we have on very thin margin.
Yeah, look, I don't know a lot about the agency model because I have no experience with it, but I've heard it's working in certain areas and not working in others, so I'm not sure about that. But I think to say that dealers make and rely on the OEM incentives, I think that's maybe pushing a little too far.
Yeah. There is a bit of
but
risk.
I think there's a bigger issue is the reliance on back-end income, and the risks coming that you mentioned earlier in terms of the focus on DRC, etc. I think that we got to be very, very cognizant of, because there is that opportunity from time to time to rely on manufacturer variable marketing incentive, because and certain campaigns are launched with that intention in mind. That's what the OEM wants us to do, and trade for a period of time like that, maybe where there's excessive stock or whatever. But it's not a general model. So I think more important is the overall contribution of our F&I income, and I know Chris has a lot of thought on that, but around that, where we're looking at these new regulations and coming in. But that's going to be a discussion, I think, between us, the banks, and the OEMs. There's a certain level of investment that has to be covered to maintain certain standards. And we're a very complex market with a very, very low throughput.
Exactly.
Relative, if you just took the total cost of dealer investment in South Africa and you divided it by the throughput and you went and compared it to the US or Western Europe, it would be a very, very different number.
Yeah, 49 competing OEMs with the throughput that we have. It's one of the most complicated markets in the world, and there's more coming, and more Chinese, more potentially Indian, etc. So that the market is very complicated. We have hit our full hour, so that brings us to the end of the broadcast. Chris, thank you very much for joining us. Much appreciated. Mark, thank you for joining us. Any other questions you have, please submit to Gary McGraw, or any other questions we'll try to answer with the panel behind the scenes. So thank you very much, everybody. Much appreciated. And any other questions, you can hit with us and we'll let you know when the next DPP program is. Have a good day.